Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 3, episode 27, and also part 5 now of raising funds. I know in between we sort of mixed in distressed properties, or actually we continued on and we jumped off of distressed properties and then went straight into raising funds a few episodes ago because of a lot of the questions that I've been getting from you guys. And so today I really just want to take this opportunity in this episode to sum up a few key points and the principles and also the mindset so that you can continue to grow your portfolio and continue to make a difference financially in your lives and all the lives of the people that you will be investing with. Because as you know, if you've been watching my Daily Dose with Tim, you understand that that is a very, very core value and very core concept, especially when it comes to really how you can continue to scale, is that we want to create scenarios where it's always win-win. And so on that note, first thing first, because I got some comments on the previous 2 episodes here. So I just want to make sure that we bring this up one more time so that everybody is very clear about the deal and how I was speaking to it. Okay. So if you want, really, I mean, what you need to focus on are some of the key figures here, which are the profit as well as the invested amount. Okay. And so this is the flip deal. This is the flip deal, not the burr. This is the flip. Okay. So just make sure that you keep some of the key points here, because what I want to really walk everybody through is, because I know in some of the previous episodes, I was sort of doing an Ontario tour, as some people will put it, and finally home now, made it home late last night. And so today is the first day back. And so I have my equipment around so that we can continue to do the other format that I'm very used to, which is writing things down. So with that said, I want to make sure that you are very clear about what we're doing here, okay? So even I'm going to do a screenshot right now or take a picture right here, because that's what we're going to be doing to continue the daily dose today. Okay, so with that said, I also want to quickly share the fact that so many of you have been asking questions about my example in the previous episodes about the pre-construction condo in downtown Toronto. So I'll go over that too. And just so that everybody is very clear about this part, we are in season 3, episode 27, and this is raising funds part 5 now at this point. And first thing first, again, one of the first things that I learned is you want to be the bank, so to speak. Okay. So when I first learned that, I was a little confused about what that truly means. And at the end of the day, this is sort of my version and my interpretation of it. Sort of got a weird slant going on here because of my writing pads. So I'm actually using a brand new one today. So hopefully I'm just getting used to it. However, I'm hoping that it is still legible to most of you. Okay. So here we have investor, and that's us, really. So that's us. We are the people that are in between the two main components when it comes to doing any sort of deals and transactions. I don't know what I just did there. Oh my goodness, hang on. Okay, there we go. And so the way I look at it is this. Hang on a second. Okay, is on the one side, we are raising funds, okay? Which means we get access to OPM. And the funny thing is, if you've actually come to any one of my live workshop or live trainings, which I'll share with you how you can attend in a little bit, is this. I always like to actually stretch it out to other people's money. Sorry, I want to stretch out OPM into OPM. And so, okay, first thing first, I know if you've seen this already, you probably already know what this means. And if you haven't, please don't freak out. I am not encouraging you to do anything that's bad for you, that you don't want to be doing. However, it's just that this is one of the ways that I really learned. And I thought it was so incredible, and it was a big aha moment for me. So instead of just other people's money, so we are looking at other people's inactive, okay, and underutilized money, okay? Others people's inactive and underutilized money. So I know OPM are, there's three letters are still a part of it. These two, I and the U, are the main differences, okay? And the main differences, I think a lot of times really can serve as a trigger point for us to think, ooh, okay, whose money is actually inactive right now? Inactive money is money taped to the back of your toilet and under your mattress. I'm just kidding. Inactive money usually is an excessive amount of money parking in getting parked in a savings account for a lot of people, okay? And underutilized includes savings as well as all the other traditional ways that may not be serving your potential money partners. So for example, as we talked about, those things could be your certificate of deposit. So that's GIC in Canada, or that could be RRSPs. That's also 401k in the US. I know this is the US side, this is the US side. And then we talked about savings. We talked about maybe your stock portfolio, maybe your pension funds that you are able to control. Whatever the case may be, I hope that this helps you really create a bit of a how would I call it? A mental list and a mental reminder of when you're raising OPM, what could actually qualify for it. And then on the other side of this is we have access to deals, okay? So deals are found, are analyzed. More importantly, they are structured, okay? Man, I'm getting like a 5-year-old writing going on here. So found, analyzed, and structured so that you are able to truly share the wealth, okay? I really, really want to stress this, share the wealth. I swear my handwriting is usually better than this. This is really weird. And somebody just rang the doorbell. So anyways, you want to really focus on sharing the wealth so that that makes it a lot easier for you to raise funds, and it makes it a lot, I think in the long term, a lot easier also for you to create a sustainable portfolio. Because I always like to say this, honestly though, it is so easy to gain access to money at times, and people just get impatient and they are uneducated, and that's where mistakes happen. And again, real estate is one of those asset classes where if you know what you're doing, it is so lucrative and it's so profitable, and you can truly create financially win-win situations at all turns. However, again, when you just park money for the sake of parking money, you might not be serving yourself in the long run. Okay. And so my goal and the goal of Trust Your Talent is train you so that you are creating a long lasting financial portfolio that is going to feed you and feed your children and feed the generations to come. That is the whole point. And that's also why one of the core values that I have, which is also one of the core values of Trust Your Talent, is sustainability. Because some of us can work really, really hard, and we can be very good at our jobs, and we can create some amazing financial successes in a short period of time. However, is that sustainable? Are you able to continue to work 80 hours a week for many, many, many years? I'm going to guess not for most of us. And so sustainability also needs to take that into account. And that same behavior and that same mindset need to be transferred over to you and to us as educated and professional investors. Okay. And so when you have this kind of mindset, the idea really is, I'm going to continue on. The idea really is the fact that we always say, okay, when it comes to credit, okay? When it comes to credit, I'm gonna write it out. I think I've asked you guys to write this out before in previous episodes. However, I'm gonna write it out this time now. Like I said, this episode is kind of a summary to sum it all up. So when it comes to credit, it's better to have it and not needed. Okay, that's the key here. Than to needed and not have it. Okay, I think once we actually write this out, oops, this did not complete properly. Once you actually write it out and you can see it right in front of you, okay, it's better to have it and not need it than to need it and not have it. Okay, by the time you need it and you don't have access to it, then you're pretty much trapped. And so this can refer to good debt and bad debt all at the same time. And so coming back to the deal example that we had, right? So leveraging Jeffrey's deal, where the profit is 46,000. And as we mentioned, money in is 131,000. However, really, if there is no BTB, it's actually 203,000, okay? This is without seller financing. So it just depends on how you want to look at this. And I actually touched on this a couple of episodes ago. However, some of you did have questions because I spoke to it, and many of you need to see it to really understand what I was saying. And so when I mentioned, maybe some of your investors, when you are saying that, hey, you know what, some of the deals you are able to actually help them make decent double-digit returns. And again, we don't promise returns. We don't guarantee returns. We don't even advertise returns. When the only times we talk about returns is when we are actually showing them the deal analysis. Let the numbers do the talking. However, clearly, there will always be some sort of disclaimers there that you will have to work on with your tax advisor as well as your lawyer. Okay, so a lot of the templates are given when people are going through the courses at Trust Your Talent. However, the idea is that you are trained on how you present your opportunities and your deals in a way that is legally responsible. Okay, so I want to make that very clear so that it does not get taken out of context. And so let's just say that, you know, these guys, your cousins in my example here, and it could be your bank of love, let's say your parents, they are saying, you know what, I am willing to help you out on your first deal here. Because sometimes that's all we need. We need that first deal to build that track record, and that it gives us the confidence and the posture. Remember, the confidence loop, so that we are able to go out and speak to our immediate circle of influence so that we can start to satisfy and help more people financially. And so let's just say that a lot of the things that they're investing in, maybe, you know, after combing through their statements, you remember I talked about that, you ask them to see their statements, and maybe they're saying, you know what, in the last 10 years, it's basically been an average of 5%. And actually having run your own numbers, you can say, you know, what if I can potentially double that, okay? What if I can potentially double that? So this is all, again, the numbers are all based on your deal analysis. And now I just want to walk you through a thought process, okay? However it is you want to present it when you do that, that is completely up to you. And again, when a deal happens, you can work with your mentors for support so that you can speak to it clearly with your potential OPM, okay, or OPM. And so let's say if they're saying 10%, well, 10% is usually per year or per annum, if you want to be a bit more technical. Okay, so what that means is if it's 131K, because you still negotiate it, just like Jeffrey, because he's well-trained, he's a trainer and a mentor now, so that you only need to put in 131, or your investor only needs to put in 131, that means the 10% per year return is 13,100. Just grabbing my calculator here. And so 13,100. And if you remember, this is a 3 months deal, which means on an annual basis, you have 4 quarters, okay? 4 quarters. That means every 3 months, really, if you're borrowing 131,000 is 3275. Or if assuming that you are not well-versed in raising funds or speaking or asking for seller financing or even structuring yet until after you've taken creative financing, that's totally fine. So what this means is 20,300. And again, you divide it by 4. Okay. So this means 5,100. 5,100. And you have a profit of $46,000. So what that means is upon completion of the deal, you, the investor, okay, the managing investor, as we call it, and the money investor, basically 3275, and you will actually take home, what is that now? 46000 minus, oops, 3275, that is 42,725. So if you remember a few episodes ago, we already actually ran these numbers. However, a lot of you have been asking me to really explain that to illustrate it. So I want to be sure that you are clear about this. And so same concept here now. If 5,100 is what you're paying your investor in this particular case, I'm going to use a different color just so that we are not confused, okay? That way, your take home is actually 40,900 instead. Either way, everybody's winning here. You're winning by having invested in your own education, having your own support, having to be able to execute a deal properly when other people may be taking 4, 5, 6, or 12 months. You are controlling the deal very well at 3 months with the support of your mentor and a community. And you are able to take home anywhere between 40,000 or almost 41,000 to almost $43,000. And you can duplicate this because, as we mentioned, what is your cousin going to say? So I was going to invest in another property anyway. However, our mortgage broker or our banker already told us that we got to invest a little bit better so that we're not killing our own mortgage qualification. So they decide to do this deal with you, and they really don't have to worry about much other than signing paperwork and cashing in a check at the end of the day. What do you think they're going to say when they get $5,100? Okay. And remember, we also talked about the fact that some people will go, well, hang on a second, that's not a whole lot. That's not really a whole lot. Well, then this is where it is completely up to you. Remember, I mentioned that in the beginning of my career, there were deals that I was giving away 80% of the farm. And so what does that mean, 80% of the farm? Well, again, $46,000 at 80%, okay? 80% of the farm, meaning I basically am very transparent with them. I say, well, we're estimating a total profit of 46,000 after 3 months. So times 80%, that means 36,800, okay? 36,800. I mean, this is insane if you think about it. And that's every quarter. So that really means if we were to annualize it, if this is the way you want to position it, you don't have to do it this way. However, if this is the way you want to position it, it's 147,200 if you do it 4 times a year. And let's assume, okay, assume no VTB. Once again, that means they need to come in with $203,000 plus qualification, okay? And then at the end, if they do it 4 times with you, return on investment, 147,200 divided by 203,000. Oh my goodness, what is that number? You are basically giving them 72.51% return on investment. Or again, in this particular case, you can call it cash on cash. The funny thing is, I'm gonna share this with you. So many people, even if you were to tell them, especially when they are what I call uneducated money, I mean, I'm hoping that you will educate them a little bit so that they feel confident and comfortable enough to go into the deal with you. However, I remember when I was illustrating the numbers to some of my earlier investors, they are going, what do you mean this deal is going to make a 30% return on investment, 25% return on investment? That seems too good to be true. And again, this is where the education really comes in. You walk them through the logic, the numbers, how the numbers are put on the spreadsheet, and the due diligence that you have done to support the assumptions and your own stress tests in the spreadsheet. And numbers don't lie. That's the thing. However, they actually really shy away. They start to second doubt, and they start to question the deal and your credibility because you're paying them too much. You're giving them a number that they never thought was possible. Okay. And so this is why it's funny in the sense that over time, you will actually learn that even if you just give a little bit away or you share the wealth 50-50, that's more than enough to go around for everybody involved. Okay. And so hopefully that clarifies it. Last but not least, so many of you were asking about the Toronto condo example. Okay, so as I mentioned, in 2018, my friends, they're a couple, they bought a property on paper for about $550,000. It's a little studio in downtown Toronto. So it's very small because I think the average pricing, even back in 2018, was already about $1,100 or $1,200 per square foot. And also depends on the builder, depends on the neighborhood, and depends on the build quality. At the end of the day, after all is said and done, when they closed last year, they need to come up with almost $100,000. Okay. So almost $100,000 in closing costs, which, funny enough, they were actually never told in the beginning. And people came back and said, yes, you were, yes, you were, yes, you were. However, they were all in very, very small fine prints. Luckily, they had the resources to close on it. And at this point in 2023, builders have listed 4 units for sale, okay, at $599K. I want you to think about that, okay? Here, and this is the example that I was sharing with everybody yesterday, because again, even though right now on paper, the fair market value today should be approximately 700,000. I believe they told me that it could probably have an upward of 720,000. However, again, I always like to do worst case scenario so that every additional dollar that you get is gravy on top. Okay. And so $700,000 at 5% commission in Ontario, that is 35,000. And then you still got to add the 13%, what they call homogenized sales tax. Okay, so 35,000 plus the 13%, really it's 39,550. So that's about $40,000 right there. So even if they were to sell it, okay, without legal fees, without any other penalties, without any other potential fees, their take home at this point is $660,000. So forget about what the builder is doing. Okay. And like I said, I was completely shocked. I thought in 2018, so many people were just simply lining up to buy pre-constructions. Turns out the building was not sold out. And sometimes builders do hang on to a few units for themselves for whatever reasons. In this particular case, it's their piggy bank. So now they're selling the units, maybe for some cash injection for other projects. You don't get to control any of that. So even if it's just this is 5 years, okay? 5 years in to close and to buy in total. Let's just say that they needed to come up with 20%. I actually don't know the entire number, but I'm just going to do a very, very high level minimum standards here. 20% to close on 650 in total, they sink in $130,000. Okay. $130,000. So let's just say that, let's calculate the return on investment if they actually did sell it, which is $10,000 divided by $130,000. And then let's just say that year after year over 5 years. So 10 divided by 130 times 100%, and then divided by 5 years. That means, oh my goodness, is that right? 10 divided by 130, that is 7.69%. Divided by 5 years, that is 1.538% per year. And I rarely ever say this, and this is why I think amateurs are in a lot of trouble, especially with the rates going up. Okay, so even if this is not the scenario in terms of value, I understand that fair market rents are not sustaining the property values, especially in a major city like Toronto. And so at 1.538, like I said, you'll rarely ever hear me say this. I probably would have encouraged you to put that money into a guarantee investment account. So a GIC, or for my American friends, once again, it's your CDs. I think you can probably make better money without having to go through the hassle and the surprises of having to come up with additional expenses to close. So here you have it. I mean, everything that we walked through over the last few days, I hope that it's been illustrated enough so that it's clear to you now in your mind. And as I mentioned, my goal really personally is to help you not have to worry about money 2 to 5 years from now. And that's also why in Trust Your Talent, our mission statement is to help you create financial independence one person at a time. And most of the times people achieve that in the next 2 to 5 years. Again, it's not about quitting your jobs. It is about making sure that money is no longer a source of stress, and that you understand how to make it, how to manage it, how to control it, and how to leverage it and work for you at its fullest. Okay, so I will share with you on June 24th, we have our next online live bootcamp that is going to focus on real estate investing strategies as the curriculum to show you financial education. And if you're in the Greater Toronto area, we also have a live workshop coming up in July too. So I will be putting those links. Invest in yourselves. Take action right now. And if you want to go further, you will be able to go through a 3-call process with one of the strategy coaches on the Trust Your Talent team. And again, there is absolutely no obligation and no pressure for you to do that. However, I do encourage you to take advantage of that. And many of you already know that the Trust Your Talent Academy curriculum, because I do remember doing a special episode because many of you were asking. So the Trust Your Talent curriculum actually is 1 or 2 years long. Many people in the Trust Your Talent community, even after they've graduated and completed their 1 or 2 year programs, they continue to stay on as alumni and continue to stay involved in the community. Because once you're in the Trust Your Talent community, you will see the difference in terms of how we do things and how we create sustainable wealth for everybody in the community through the different methods and the money mindset and the education programs that we have. So on that note, thank you so very much again for joining me today for my Daily Dose with Tim. I hope that you got a lot out of all the raising funds episodes so far, and also distressed properties. And we are going to go into a different topic starting the next episode. However, I'm going to keep that as a little bit of a secret, and I will see you back at the next episode. Have a great rest of the day. Live well, everybody.